So the recording is going to be a little bit wonky here, but that's okay. I don't imagine anybody's ever going to use this recording, actually. It's probably a waste of effort to record it, but what do you do? Okay, so for the exam itself, you're going to, as I said, bring the 3 books with you. The Glenn Stevens book and the Christine von Kauenberg's books are going to have the vast majority of the answers. Pretty much everything you'll be tested on will show up in one of those 2 books. I'll be surprised to see much outside of those 2. Okay, so I wouldn't bother lugging a bunch of other stuff with you. If you have some reference sheets that you like to use or anything like that, bring those along, that's perfectly okay. Okay, watch for, I've chosen some topics here you might see. Definitely know your capital dividend account, lifetime capital gains exemption rules. We're going to see a principal residence exemption presentation today, which is good. You may or may not have a corporate buy-sell walkthrough like we did last time. That's where we're going to spend the majority of our time in prep, just because it's a good concept for testing purposes. Even if you don't see that exact thing on an exam question, the benefit to those corporate buy-sell scenarios is that they're very sort of step-by-step, and if you get used to doing things that way, that will serve you well on a variety of different types of exam questions. Okay, we've got family trusts, and just one second here, sorry. Family trusts and family law. So we're going to do family law today. We're actually going to do both those topics today, and that works out nicely. We did, last time we were together, the alter ego trust. I think, Chris, you gave a presentation on the alter ego trust. So go ahead with that. Sorry, with that again, that's good. You can just refer back to that. Okay. The whole exam is all short answer. It's all handwritten, so you'll have an actual paper exam in front of you. I suggest that you answer things bullet point, no long paragraphs or anything like that. That's how I tried to get you to do your assignments. If you go back to how you submitted your assignments, that should be a fairly useful exercise. I think for those that were a little bit long-winded in the assignments, I pointed it out. So you may have to pare back that tendency a little bit, or else you'll run out of time. Okay, it is important to kind of get to the point and get done. Most people will take over 2 hours. Most people probably take 2.5 to 2 hours and 45 minutes. You might end up taking the full 3 hours. Okay, and I think you're better off here to do sort of well on 75 to 80% of the exam, and maybe miss. I'm not sure, Chris. It's not like your FPSC exam where it's so so structured. So you're going to have different lengths of cases. You'll have very short cases. You might have 1 or 2 longer cases. Okay, I don't know, and it varies from exam to exam. So they don't have some set number where they say it's 6 cases and that's all you're going to do. Okay, and biggest thing here is to know the texts well, that you're able to find your references quickly, and especially anything where there's sort of a how-to type of instruction. Anything that describes, you start off here, you work through these steps, and you end up here. And I'm going to show you an example of that, something that does occasionally show up on the exam. We're going to see that a little bit later on. Yeah, I'm going to do that, Curtis. That's one of the things on the agenda today. Yeah. Okay. And I will note here that you kind of have the best of both worlds with respect to tax changes. that you're going to be marked as right. If you say something that's in the text, I think this is dumb. I think this is the wrong way to test people, but I mean, you benefit from it, so take advantage of it. If it's in the book or it's real life, it's correct. Okay. So as long as you have it in your book, then you're okay. So for example, when we talk about passive income, you won't have to worry about a reduction to small business deduction being tested, although if you're already current on the new rules and you use that on the exam, you would be fine as well. Okay, so you're tested sort of on whatever that is, the best of both worlds. Okay, all good? All right, so just a little cleanup that I have from last time we're together. It's a slide that we didn't get to last time, and that is around international issues with trusts in particular. And there's actually quite a bit to this, but not too much you have to worry about for testing purposes. Still, there are some things worth knowing here. So we use a trust. They're an integral part of estate planning in a common law system. And that comes about one of two ways. First off, we know this is true because our estate is a trust, okay? And the executor is a trustee, and all the stuff that goes along with that. And then also, we saw last time, and we've seen this before, that we often use other trusts as part of our estate plan. So Chris gave the presentation last time about the alter ego trust as the will alternative, or the spousal trust, or to manage an inheritance. All of those different reasons to use a trust, all the sort of trust applications we've previously seen. Well, one of the challenges here is that trusts have not traditionally been part of other legal structures. Now, Quebec does have them, but most countries that follow the French legal tradition do not have them. So it's not good to assume that you have a trust in any other given country. Now, actually, curiously, France itself introduced them in 2014. So they have them now. But if you're dealing with somebody who has assets in another jurisdiction, then you don't have access to trusts that way. That's good. Sorry, another jurisdiction that follows French law. And that can be a little bit messy. You may assume that a trust would be available, and it may not end up being available owing to the particularities of estate law in that jurisdiction. So never assume in an international situation that you're going to have access to a trust. Now, the other thing here is where you have a non-resident trustee, and the most common example of this would be, and I think, Dennis, didn't you and I have a conversation about one of these once? The most common example of this would be a US-based executor for a Canadian resident. Okay, if anybody did the Catherine Parker case study as part of your capstone course for your CFP, you've seen this. And the challenge here is that a non-resident trust has some disadvantages. Okay, first off, no capital loss carryback. And because there's no capital loss carryback, that would wreck your share redemption agreement. Right, we need that capital loss carryback to get our efficiency out of the share redemption. No graduated rate estates. And you're going to use the non-resident rules for your principal residence exemption. Which means you lose the +1 in the formula. Okay. That's good. So this sort of assumption you got to trust and it's going to work, well, that's not always going to be true. And I would suggest, now it depends on the value of the estate. If you've got a lower value estate, and if I remember right, I can't remember who it was. It was somebody in Saskatoon. Maybe it wasn't you, Dennis. I'm sorry. In fact, I know who it was. It wasn't you. I apologize. If you've got a non-resident trustee or a non-resident executor, and you've got a fairly small estate, it's not probably that big a deal. Although that person may have to file a bond, that's a different question. Sometimes a non-resident trustee has to put up a bond in order to act as the executor in the jurisdiction in question. Okay. But if you've got a smaller estate, maybe not that big a deal. Maybe you don't need those benefits, but on a larger estate, I would consider a professional trustee resident in Canada okay? And you can ask that trustee, you can say, hey, why don't you get advice from the non-resident to at least get their input on issues or whatever it happens to be. But ultimately, you want the mind of the trust its control to reside in Canada. Okay. Any questions there? Has anybody ever had this? Anybody ever have a client who actually was looking to name a non-resident as their executor on their estate? I would guess you would see it more frequently in a place like Vancouver, maybe in New Brunswick, where you're stacked right up against the border, and there tends to be a fair bit of sort of back and forth across those borders. Okay. I think this is what you're looking for, Curtis, is the US estate tax calculation. So we're going to do this for a non-resident alien. Okay, this is a Canadian with US assets. That's good. We're not talking about a US person here. That would be a different calculation. Okay, that's a different question. We'll do that separately. That's much easier, actually. So for the US person, we can just show that real quick here. It is $11,200,000. Is that the amount this year? I have it right handy here. Yeah, 11,200,000. Of worldwide assets. Okay, and you're going to trigger a 40% tax on anything over that. A spousal rollover is available to that. Okay. That's good. And that, by the way, is 11.2 million US dollars. That would be about whatever it is, 14 million Canadian, right? This is all measured in US dollars, of course, right? You're dealing with American taxes. Okay. So the Canadian with US assets kind of gets the same deal, that you get an exemption on that $11.2 million. Now, the reality is this 40% tax, it's actually a graduated rate tax. The way it actually works is it starts off at, I believe it's $14,000, and it's stepped up from there. So you have this sort of series of steps like this. And then the last one, of course, is huge. Okay, kind of like this, where you start off at a little 14% tax rate, and then you're at a 16% tax rate. And then it gradually increases until it gets to the 40% tax rate up here. Okay, so that estate tax grows and grows and grows and grows. It hits 40% when you're at the $11,200,000. And really, everything up until that point is exempt. Okay, so let's see what this means. So my Canadian with US assets is only subject to US estate tax. Yeah, it is the tail end of chapter, and Chris, I'm showing you how it works today. Your textbook might use a slightly outdated example. I can never remember what they do in this book. But if you go to chapter 6, page 642 and 43. 640, starting on 640. Okay, honestly, what I'm going to show you on the board, though, is easier. Chris, if you just follow what's on the board, you'll be in better shape. Okay, so this Canadian is only subject to US estate tax if they fail a test, if they have over $11.2 million, again, same deal, US dollars in worldwide assets. And that's not enough. That doesn't give you any connection to the United States. So you also have to fail if you have over $60,000. You also have to have over 60,000 US dollars in US situs assets. And that is something your book does a pretty good job of describing, is what are actually considered US situs assets. And that really starts off on page 6-36. Yeah, and in fact, if you go back earlier than that, Chris, you can kind of see the different rates of estate tax. There's your list. US cited assets are on page 629. Okay. Okay. And now what happens is, let's say we have a Canadian resident. Okay, so Canadian non-resident alien, and this person dies with, let's give this person $800,000 of US assets, okay? And that might be US stocks, maybe a vacation property, whatever it happens to be, okay? And they have, let's say, $16 million of worldwide assets, okay? So what's going to happen here is they're going to get a portion of the credit associated with this exemption that sits over here. So in fact, what would happen here, if you calculated up the value of the exemptions that I showed you on the right, so if you added up the value of all the exemptions, basically on a graduated basis, it's kind of like a graduated tax rate, right? That would be worth, in 2018, $4,425,800. In your text, since you asked, Chris, in your text, you'll see the different exemptions described on page 34. Okay, and you can see this in the middle, or I guess the middle right-hand column, where it shows unified credit. Okay. That unified credit is the same amount as we're showing here. I think everybody is aware that the US estate tax is on a lot larger amount. It effectively doubled with with this year's new tax legislation, the Trump, what do they call that? The Tax Cuts and Jobs Act or whatever. With that new legislation, this effectively doubled the exemption. So that's where it's so much larger. Everything is larger than what it used to be. So everybody following me along here? Are we okay? Is anybody completely lost? Uh-oh. All right. I hope the chat box is just slow here and everybody's typed up a quick chat message. This does make me a little bit nervous. I got nothing coming through at all. Let's assume that I've got it right. Okay, good stuff, Chris. And it's making sense? Okay. All right, I got you, Dennis. Okay, good. So what would happen for this Canadian is we would take their $800,000 of US assets. And again, that would be determined in US currency, US value. Okay, and we would apply the 40% estate tax to that. So this person would have a $320,000 estate tax bill. But they would also have access to the exemption. So the question then is, how much of the exemption do they have available? And the way you're going to do this, you would take the $4,425,000 800 times the proportion of their assets that are in the United States, which is 800,000 out of 16 million. And by the way, that 16 million includes the US assets, right? Their US assets are in the world. So if you had all of your property in the United States, which would be bizarre for a non-resident, but whatever, if you had all of your property in the United States, you would have 100% of the exemption available. Okay. And that would give access to, that's going to be 5% of the exemption, right? That would give access to $221,290 of exemption. And so that would get knocked off that estate tax bill. And you would end up with US estate tax payable of, what's that going to be, $98,710. Okay, and this is pretty common. We, I think, sometimes put a lot of attention onto this, but this person ends up with a really low amount of estate tax, right? It's not a huge deal. And you can see where there's a linkage between the available exemption and the amount of US property you have. So, you know, if you had a larger amount of US property, you have more exemption available, this tends to be a relatively small amount. And what I would consider kind of reasonable calculations, unless you've got somebody with 30 or $40 million of assets, generally speaking, I see estate tax bills that are, you know, in the $100,000, $200,000, $300,000 range, excuse me, at the most. Now, nobody wants to pay tax needlessly. The other noteworthy thing with this estate tax is that you can use this. This will generate a foreign income tax credit against your Canadian capital gains tax on disposition of that US property. Okay, so for example, let's say that you had, with that US property, now keep in mind that that's all US dollars, right? So let's say that you bought the property for $200,000 Canadian, okay, so that's your ACB, and now it's worth about 1.1 million Canadian. Everybody agree with that? That'll be your deemed proceeds. Okay, that's US 800,000. Is everybody with me there? So you would have in Canada with this property, you would have a $900,000 capital gain, which is $450,000 taxable. And let's say you're at a 45% tax rate. So that would give you $202,500 of Canadian tax liability. Minus your 98,710 of US tax liability. Give you 103,790, would be your net Canadian tax. Okay, that's good. It's not that complicated, right? I don't think it's complicated. I just think it's not terribly well explained. I think that the book kind of goes into this long and rambling explanation about it, but I think the math is actually pretty straightforward. Okay? And I do think you'll find this is easier than what's in the book. If you can just plug in the exemption, the proportion, you should be okay. Now, they could ask you a question about a given year, so they could say, a person died in 2012, what's the exemption? Oh, by the way, there's a typo in your book on page 34. I believe you still have the same typo on table 1 on page 34, 6-34. It shows 2011 to 2011. That should show 2011 to 2012. Okay. Oh, what's on your page 34, Chris? 6-34? What do you have there? Uh-oh. Hang on a second. You're still in the right, it's about US stuff though? Yeah, it'll be, okay, it'll be sequenced a little bit differently. It's not that big a deal. I know what you're looking at then. That's a little bit deeper in my text. So they've carved some stuff out. It's in there somewhere. Somewhere in there, there'll be the little chart that shows the US estate tax exemptions. Somewhere in, this is, yeah, the coil bound book, yeah. Okay. That's good. So I just find that page, Chris, where they show the exemptions and flag it, and I would find the page that shows the US site as assets and flag it. Those will be the two most common exam questions, or those will be where you'll find the answers to the two most common exam questions. Okay. That's all good? All right. Dennis, did you want to do your presentation now, or do you need a few minutes? Do you want to wait till after the coffee break? I'm good with either, actually. I was thinking about it, and I'm not sure there's any. Okay, perfect. Okay, so Jessica was good enough to send me an emailed question, and I think it's an appropriate thing to go through. I think it's a good use of our time. So we're going to dig a little bit into the family trust. We've done this a couple times before, but it's not always intuitive. I get that, and it makes it a little bit complicated. So there are many different ways this can work. Okay, this is the reality, is that there are probably 30 or 40 different versions of this. But fundamentally, they're all going to do some similar things. Okay, now I'm going to show you starting with the old rules, and then I'll show you with the new rules. Okay, so here's what I've got. Got Dave here, okay? And Dave owns 100% of an operating company. This happens to be a QSBC, so it meets all the active and passive tests. Let's say we've got $4,200,000 of active assets and $300,000 of passive assets. Really, that portion of passive assets is relatively inconsequential. Okay, and so we have then our corporation here. Okay, And Dave has never done a freeze or anything like that. He's got no ACB, but he does have the lifetime capital gains exemption available. Okay, that's all good. There's nothing there that doesn't make sense. Now Dave has a whole busload of family. Okay, he's got his spouse, Wendy. He's got 3 adult children. Okay, 2 of them are married. He's got 7 grandchildren. Okay, and those are all kids. They're all minors. Okay. And what Dave is going to do here, he's first off going to use probably Section 85. This would be a time when I would suggest that we would use just a conventional Section 85 rollover to accomplish an estate freeze. And simply, Dave takes his shares of Corpco and he rolls them into a new holdco. Okay. And we're going to go with what probably is the most logical way to do this in this scenario. And this is going to be a little bit complicated, more so than normal. I'm going to add a little bit of an extra step here, but it's actually a fairly simple step if we can just look at it on its own. So Dave is just going to put 90% of his shares into Holdco. Okay, he's going to retain 10% directly. All right, that's all good. Okay, and so Dave owns 100% of Holdco, and he still owns 10% of Corpco. And then what he's going to do, he's going to move the passive assets up into Holdco. Okay, and that's just a straight up intercorporate dividend. Now, he does have to follow the safe income rules. That's a little bit more difficult than it used to be, but let's assume that's all after-tax money. That's going to work out reasonably well. And he's going to then Section 86 and convert his and Holdco's shares of Corpco into preferred shares. Okay, and those preferred shares will most likely be frozen shares. They're going to have frozen values. That's what he wants to do. They're going to have heavy voting rights. And they're going to potentially be redeemable. Okay, and I'll show you that later on. I have a slide for that later on. And this is going to be referenced to thaws melts and unfreezes. Okay, it just gives him a little bit of flexibility, which I'll come back to. Okay. Everybody's happy with that? So then the question is, who owns now the growth of Corpco? So Corpco is still a growing concern, or a going concern, I guess is a better, okay, going concern. Its value might increase. Dave only owns pref shares, and so does his holdco. That's true also for his holdco. And so now who will own the growth? Okay, is everybody with me so far? And you see, I have really done this sort of step by step. Now, one thing that I forgot to do here, sorry, is I forgot to get Dave to use his lifetime capital gains exemption. Dave would certainly use his lifetime capital gains exemption when he executes this freeze. Okay, so when he moves the 90% of his shares into Holdco, now he's going to have an ACB of $848,000. Okay, he uses his lifetime capital gains exemption. Okay, now I think I've got every step in there. Okay, so now let's say, for the sake of argument, that Corpco is going to issue 1,000 new common shares from Treasury. Again, of course, that's completely Dave's call. He's the only one who's really exercising any control over Corpco here. Now, these shares have no value. There's no actual value associated with them. All the value right now is trapped in Dave's shares of holding company. The only value that these shares will have is whatever anybody pays for them, and then any future growth. Okay, is everybody with me so far? So now we're going to probably get somebody unrelated to Dave, right? We don't want any attribution concerns, and we don't want this to be a revocable trust. So we're probably going to get the family lawyer. Okay, by keeping Dave out of this, now it's not a revocable trust because Dave didn't settle the trust. Okay, and our family lawyer settles the trust with a $20 bill or something else that's a fairly insignificant value. Okay, and now we create the trust. And we're going to have to figure out who a trustee is. This is often the most difficult part of this. Okay, what I would prefer to do is use one of Dave's kids. Okay, and if the answer to that question is no, then we can start looking at other options. Okay, so if Dave does not have a kid in the business, then we start to shop around a little bit more. Then we look at can Dave be trustee? without triggering attribution problems. And that can be difficult. That's where we need the tax lawyer. We might need a professional trustee here. Maybe we use all 3 kids as a board of trustees. Okay, we've got to do something. Okay. And this is going to depend on the type of advice you receive, what your ultimate goal is with the trust, whether Dave is going to have some situation where he could end up getting some benefit later on. For example, if Wendy predeceases Dave, does that make Dave now potentially a beneficiary of the trust? And if it does, and he's also the trustee, potentially now we have a revocable trust, which is not necessarily what we're looking for. Okay, so we need something here. And we're going to have a whole range of beneficiaries, just a boatload of beneficiaries. We're definitely going to have Wendy as a beneficiary. Well, as the trustee, Alan, he could. Yeah, Wendy's another option. One of the problems with using Wendy is you get into this question of whether Wendy is really the one who is exercising the trustee rights, or is it Dave kind of just using Wendy as a puppet, what we call de jure control? Sorry, that Wendy would only have de jure control and Dave has de facto control, and that could lead to problems. So maybe Wendy, okay? But I would suggest if you name Wendy as trustee, it's probably not much different than naming Dave as trustee. We're gonna have the kids spouses, the grandkids. If any of the grandkids were married, we would name their, yeah, not pleasant, Alan, right? Okay, and you do have to acknowledge that reality, right? That people get divorced. Okay, and often another trust and maybe another corporation as well. These are all fairly common arrangements. Now, at this point, the trust doesn't own anything, so now what has to happen is whoever that trustee is, the trustee borrows $1,000 from a bank, not from Dave. Okay, we're going to go borrow $1,000 from a bank, a completely arm's length arrangement, and we use that $1,000 to buy the shares of Corpco. And now the trust owns all future growth of Corpco, which means it can take those dividends. It can start to pull out dividends as Corpco becomes more profitable. Now, what it can't really do, and this is something that we did talk about last time we were together, we can't impoverish Dave. Okay, that is, we can't pay him less dividends and the trust more, even if the shares have a discretionary dividend associated with them, because CRA will assess Dave a shareholder benefit on any resulting tax savings. Basically, this structure works if Dave is still paying the same tax bill next year after the freeze is done as he did the year before the freeze was done. So as long as we have some stability in the amount of taxes Dave is paying, this works. Okay. Now, Alan brings up the possibility of divorce, and of course, this is one of the big advantages to this particular structure, is that done properly, you do have some divorce protection here. So the trustee almost certainly will have absolute discretion over this trust, which will allow then for an element of protection for either divorce or creditor protection if anything goes wrong for these folks. Of course, the biggest risk here is still, or one of the biggest risks, is still that Dave and Wendy get divorced. If Dave and Wendy get divorced, potentially Wendy can sort of attack the whole structure of this trust. This is where one of the things that Dave might want to do to make sure that Wendy doesn't do that is to be very fair to both Wendy and to make sure that if she has kids from a separate relationship or whatever the case is, that they're getting something as a result of this. Dave has to kind of put long-term considerations ahead of just trying to create sort of an artificial benefit for, let's say, his lineage. Okay. Now, do you see why? It won't protect Brendan from, okay, so Dave's divorce won't be protected. You with me there? Are you asking about if the kids get divorced? Okay, is there some, sorry, there could be something I'm not aware of there. You can help me out with that, Brandon. I would have said yes, it does. But if you've got something that says otherwise, you should be aware of that. I'm not off the top of my head. No, that would give you protection then. Okay, yeah, there's, I thought maybe you had something here. But I'm not aware of any Saskatchewan rule that lets you poke a hole in that separation. I've certainly not heard anything myself. Okay. Just have a quick boo here. So if you have the von Kauenberg's text, it's at 6.7.12. But I don't think you get any protection here. Okay, now where there was an exception to this, Brandon, something we did talk about before, was when you try to write up your separation agreement, sorry, your prenup or postnup, right? If any of these entities have a fixed interest, okay, in their family trust, that has to be disclosed in a prenup or postnup. That's what sunk the McCain postnups. Was that failure to disclose? Okay. Any questions there? Okay, so a couple things here that Jessica's asking about. First off, yes, that's correct. So he really took back, $4.5 million, or sorry, it would actually be 4.2 minus the passive assets. Oh no, that's including passive at that time. So 4.5 million. So he takes back $4.5 million of shares here. That's only 90%, so knock off four million and 50,000. He retains 450,000 over here. And the reason I would keep that 10% off to the side, just because actually two things. First off, it's got to be 10% for him to consider Corpco related to himself. And then the reason I want that is because we know the lifetime capital gains exemption isn't stopping at 848, right? Now, I'm not too excited, Jessica, about another $150,000 of exemption. That's probably not worth adding any complexity for. But I know that governments have historically had a habit of messing with that lifetime capital gains exemption. And who knows, I wouldn't be surprised if we had a change in government in 2020, let's say, and that they decided to bump up the lifetime capital gains exemption to 2 million maybe, okay? Just because, yeah, in my lifetime, right? Just in my time involved with this course even, right? I have seen 3 different substantive changes to the lifetime capital gains exemption, okay? And that's not a long time, right? That's an average of 1 every 4 years. Although it hasn't quite worked like that, but that's really, you know, if I'm looking for a place for governments to mess with the sort of personal and corporate tax, that overlap between those two things, lifetime capital gains exemption is an easy one. I think you could bump the exemption up to 2 million and the government would have very little true tax expenditures as a result. All right. Any questions there? Okay. Good. Those are good questions. Thanks. Yeah. And Brandon, it's always good to think about that divorce, right? Should always be thinking about that. It's come up a couple times now. Kind of unfortunate, but that's reality. Okay. Now, under the new rules, what changes here? Well, the problem here under the new rules is that in the structure that I have illustrated, any dividends paid to this group of beneficiaries are going to be taxed at top marginal tax rate. That would be true if they're in the trust or if they're paid to the beneficiaries. So under the new rules, any use of a family trust type structure, any trust at all, will result in top rate taxation. Okay, so really you can't do this anymore and get the benefit of a dividend income split. Is that okay? It's a giant problem. Maybe it's not okay, but do we understand it? Now, what is still possible, and this is kind of weird, but what is still possible is to multiply for farmers and fishers. So on qualified farming property, QFP, or qualified fishing property, okay, you can still use the trust to multiply the lifetime capital gains exemption. Okay, now you'd have to have a really well-designed trust, and this is going to be an issue now. You're going to have a bunch of people who are trying to unwind old trusts. There's no grandfathering here, although there is, in order to get the lifetime capital gains exemption, there's a little bit of forgiveness up until the end of 2018. So there's kind of a form of grandfathering, but it's only with respect to lifetime capital gains exemption and only until the end of this year. It's a little bit of a tough one, okay? Practically, other than in farming situations where you're trying to use a bunch of different kids and grandkids to get more lifetime capital gains exemption, you want to pile those people on and bump up your lifetime capital gains exemption, you're not going to do this. And you're not going to pay dividends into that trust. It doesn't make any sense to pay dividends into that trust. Okay. Any questions there? All right. So I'm curious to see. Yeah, I would agree with you, Chris. Now, what you could still do here, okay, and just hang on to that thought. So now, what you could still do, and this isn't really family trust now. Where are we going to look at here? Yeah, okay, let's go here. Okay, this is not necessarily practical. You have to consider, again, that possibility of separation or divorce, but it's still possible here without the trust now to have Wendy acquire shares, okay, to have the kids acquire shares, to have their spouses acquire shares, whoever it is you want to bring on as shareholders, okay, the grandkids could still do this via a trust, okay, you can still do that. Now, the limitations here are that you have to meet a bunch of rules here, okay? So first off, Corpco, and I would suggest this is not the case in this type of business, but Corpco can't be a services business, and Corpco can't be a Prof Corp. And I've mentioned this before, but services business is not yet defined. We don't know what a services business is. We'll see if we get more definition out of this. Certainly the tax community has asked for this. Yeah, exactly, Chris, these are the new TOSI rules. Okay, so any shareholder must meet the value and votes requirement, which is that they own 10% of the value and 10% of the common shares in order to not be subject to TOSI. Or there's another way to meet the exemption, or they meet the labor contribution rules, which is going to be something like 20 hours a week of work in the business. Okay, sorry, I should say any shareholder age 25 plus. Okay, that's good. For a shareholder under 25, holy man, this is messy, eh? For a shareholder under 25, basically they're subject to a prescribed rate test. Currently 2% prescribed rate. That means if they paid $100,000 for their shares, they could take up to $2,000 a year of dividend income with no TOSI. Okay, which is a dumb rule, right? That's, I mean, whatever. I guess maybe not dumb. It's a hard rule to follow. So practically, any minors who get shares, you would just wait until they're 25 to start paying them dividends. Okay, or any kids who get shares, you would just wait until they're 25 to start paying dividends. So then you would distribute any shares out of trust. So it's not to say the family trust is dead. It's just going to be much, much more difficult to get sort of immediate good use out of it. Okay. Any questions there? And I will say that this is all still a little bit murky. We are waiting on some rules to be refined and defined. Only farming and fishing property, Jessica, can use the trust for the capital gains exemption. Curtis, they're definitely not going to test you on this. Okay, that goes back to my comment earlier. You're only sort of examinable on what's in your textbooks. You with me there? Okay, but if you answered, if you had a question where you could see that TOSI applied and you applied TOSI, you would still be correct. Okay, I'm not showing you this for exam purposes. I have to show you this because otherwise I'm negligent, right? Otherwise we're sort of showing rules that don't exist anymore. Yeah, Curtis, it is a nightmare. It is a complete nightmare. I can't agree with you more. I can't even begin to start with how difficult this is going to be for families that have really set these arrangements up and now have to go back and unwind them. Yeah, on the exam, you can use the old rules, absolutely. Okay. And I think there's even a little preamble on the exam that says something like that, or in your exam instructions. One of those places, it says that. Okay. Complicated, isn't it? I don't think, honestly, that we're going to know everything about these new rules until 3 or 4 years from now. I think that's maybe even 5 years. We're going to have to get a bunch of court cases to decide what this economic contribution is. We're going to have to get court cases to decide what labor contribution is. We're going to have to get court cases to decide what a services business is. Yeah. Okay. Yeah. That's it, right? Okay, now there is another way to do this, okay? And this is a different version of this, okay? Now, I actually know somebody who's done nearly this exact thing, okay? And what happened here, we have somebody who sold their business for $50 million, okay, net of taxes. Okay, and this person is married with 3 minor children. And at the time, they were the sole shareholder of the business. Now, what you could potentially do here is you could just invest the $50 million personally and take the income all in your hands, okay? And you would have a lot of income. Let's say you're making a 10% return, well, you would have $5 million a year of income at a 10% return, and you would lose, and this person happens to be on Ontario, you would lose about $2.5 million of that to taxes. Okay, maybe a shot less than 2.5 million. You'd have some dividend income and some capital gains. So maybe call it 1.7 or 1.8 million, whatever. But you're going to lose a fair bit to taxes anyways. Okay, everybody's with me there? So one possible solution, this is actually where a spousal loan probably makes sense. Okay, so at least consider a spousal loan. Okay, and lend 25 million to your spouse, okay? And now you're gonna have $2.5 million of annual income. And now you each get the low rate taxation, right? The graduated rate taxation on your first $300,000 of income. Sorry, 500,000 in Ontario. Okay, do we buy that? Is that okay? Now, of course, the downside to that is that the spouse has to pay you interest at the prescribed rate. At the time the loan was provided, okay, and it would be pretty common. We've had lots of periods over the last 7 or 8 years where we've had a 1% prescribed rate. So that would be a fairly inexpensive sort of tool here and fairly easy tool to make this work. Okay, is everybody with me there? So just using Ontario tax rates, Chris, right? So your first 43,000 is taxed in Ontario at 20%, and then your next, whatever it is, 3,000 is taxed in Ontario at 23%, and then your next 40,000 is taxed at, and your next 50,000 is that thing, right? Ontario has their top rate. They don't hit their top rate of tax until $500,000 of income. That's where you get into that 52% tax rate. Good? Okay. So I know nobody else does that much, right? BC for a while had that, but I think Ontario now is the only province with a $500,000 top tax rate. Okay. Right, that's the same. The difference though, Chris, is your top tax rate is only 47.5%, right? Whereas in Ontario, that top tax rate is 52.5% or 52.16% or whatever it is. I can't remember the exact rate, but okay, I think it's 52.16. And they just changed all their tax rates in Ontario in this budget. Okay, so what about a slightly different? Oh yeah, that's a good point, actually. I've got something later in the presentation. I forgot about your provincial budget. Okay. Okay, now what about if we did this a little bit differently? So what if now I set up a trust, okay? So same deal, we're gonna have a family trust type of arrangement. So we're gonna have a third-party settler of this trust, okay? Somebody from outside the family. We're gonna have a trustee, same deal. We're gonna have to find somebody we trust, maybe a professional in this case, professional trustee, okay? And my person who sold their business, we're gonna do a type of loan here. We're gonna do a $25 million loan to the trust, okay? And the trust invests that $25 million, or maybe it's more, maybe it's 30 million. Let's go with 25 million just for the sake of argument. Okay, generates returns, whatever those are, pays interest at the prescribed rate back to the lender. But it distributes its gains to the spouse and kids who are the beneficiaries. Okay, here TOSI doesn't apply because there is no Canadian Controlled Private Corporation involved. Okay, all your investments are in stocks, bonds, mutual funds, ETFs, whatever it is, probably with a discretionary money manager here. Okay. You still have your proper attribution concerns, so any dividends or interest paid to minor children is taxed at top rates, but you just wouldn't distribute any income to them in that form. Is that okay? And you're really going to use the trust now to sprinkle that income around. All right. Does that work? I don't want to launch any kind of smear campaign here, but this is the kind of trust you could set up if you had just sold a whole bunch of shares of your old family business and you have a whole bunch of cash on hand. That's good. Okay. Any questions there? All right. Okay, I've got just a reminder here. This is something that I have shown you once before, I think once before. And I just want to go back and review this passive and active test. And when do we really care about passive and active assets? When does it matter whether an asset is passive or active? Okay, and really that's it. What Dennis shows here, the lifetime capital gains exemption. Other than that, it's not something to be too fussy about. Now, passive income is going to start to matter as well under the new passive income restriction on small business deduction. And so then potentially you get this same question. All right, so let's say that I have a business owner here. I've got Kevin. Kevin owns 100% of this business. Okay, and OpCo owns, let's say, $1.2 million of machinery and equipment used in the business. Okay, and it also owns, let's say, a $2 million building. Okay, this $2 million building, we'll say it has 4 bays in it. Okay, it's a commercial building, a 4-bay commercial building. Just like so. And the left-hand bay, this is where the business is. And then the other 3 bays are all rented out. Okay, what would happen here is out of this $2 million building, we would then say, it is 25% active, the portion that houses the business, assume it's a $500,000 value for that 1 unit, and 75% passive. Is that okay? Now, similarly, if I'm going to run things like this, let's say that I've got a straight up, again, we've got Kevin here, and Kevin has maybe used Section 85 at some point and created a holding company. And this time we have the $1.2 million of machinery and equipment. Okay, and we got the $2 million building up here. Again, 25% used in the business. Well, that's still considered an active asset. As long as it's used that way. And if OpCo pays HoldCo rent for the use of that building, which it generally will, That is active income to holdco. Okay, that's really just a way of moving money from opco to holdco. It will be deductible for, well, that's a different question, Chris. Now you get into a fairly complicated scenario, and I would suggest then it doesn't really matter. Well, hang on a second. It does matter a little bit, right? Just give me 1 second here. Because you see that with dentists for sure, right? You see that where the dentist operates the dental practice and the spouse owns the building. Yeah, you could actually, that's where you, if those companies are not associated with one another, that is, if the spouse is independent of the dentist, then you would have passive income. That rental income would be passive in that case. No, it's a good question, Chris. All right. Okay. Any questions here? All right. I think we'll just do this real quick and then we'll take a break. I don't want to get into the bump rules. Honestly, they are very, very complicated. It's something I said I would mention. It's actually come up, I can't remember who it was, but somebody last call asked a question where we did, I think it might have been a question you asked last time we're together, Jessica, where we actually had to use the bump rules. And this is really Section 88 and Section 87, subsection 11 of the Income Tax Act. And what it allows you to do, it allows you to, in an amalgamation or roll up, bring the ACB of non-depreciable assets up to the parent company. Okay, it's really a way of making sure you don't lose your ACB when you put companies together. So you've got parent co, and normally you'll see it done like this, not so much opco and holdco, but parent co and subsidiary co. Okay, and subsidiary co has, let's say, some land. Okay, and the land has an ACB of $400,000 and a fair market value of $900,000, and we're going to wind up subsidiary co. Okay, so subsidiary co, the whole thing is getting wound up into parent co. Okay, we're gonna pull the whole thing up here, up into parent co. Well, there's no disposition here because it is an intercorporate dividend. Okay, there's no disposition when the land moves up. Okay, but parent co hasn't paid for these assets either, so it should have no ACB. However, even though it's not going to pay for the assets, it's going to get that ACB. So at the end of this, parent co will own the land. With a $400,000 ACB because of the bump rules. Okay. Now, there are many, many exceptions to the bump rules. This is quite complicated. I don't expect you at all to introduce the bump rules here, simply to know that they are a tool that's available, but they require good tax advice to use. There are many exceptions to them. Okay, and actually I happen to be using the bump rules this year. I have an email in my inbox right now where, and I've been teaching this for years, I've never used them before, but we have an old corporation that we've sort of been sitting on. It owns some trademarks that were useful, and it was just not worth winding it up. But this year we're actually going to wind it up into our parent co, and part of that, there's some tax losses sitting in that subsidiary co, and we can use Section 88 actually to wind those tax losses up into our parent co. Okay, that's good. Nobody cares, right? All right, that's good. We'll take a break there. Thanks for your patience with the internet going out on us this morning. I think it's working just fine now. I don't know what was going wrong. So we're gonna come back after a break, and this is why I wanted to do the break now instead of rolling into this. And we're gonna do the butterfly. And I have now 12 minutes to the hour. We'll take a 15-minute break. Now we'll resume at 3 minutes, well, now 4 minutes past. Okay, passed. We'll see you back then. Thanks.